Well, good morning, everybody. Thank you for joining me today. It's February 20th. And again, time flies when we're having fun, and can't imagine there are too many businesses that are more fun than this one. The investment business is always interesting, never a dull moment. Sometimes I do wish for dull moments every now and then, but in this business, never seem to get one. There's always something going on, and there's always something to learn that suddenly is of importance to the markets. I think these days we're all scrambling to understand how artificial intelligence works and what it's all about. I've got some of my opinions on the subject. I'll share them with you in tomorrow's morning briefing. But I love the concept. I love the concept of artificial intelligence. I love the concept of technology increasing productivity. It all fits in rather nicely with my roaring 2020s story. So from that perspective, it's great. I think that the roaring 2020 scenario really has been discounted very rapidly here by the stock market ever since November 30th of 2022. Well, what happened back then? You might recall that OpenAI made a public launch of their Chat GPT, and everybody got very excited about it very quickly. Suddenly we could ask Chat GPT to write reports for us, to do searches for us, detailed searches explaining all kinds of intricacies that are out there. We could ask it to do a portrait of ourselves in the style of Dali. We could have it write notes to our friends in the style of Chaucer. So it was really impressive, and I was really impressed by something I saw on the TV, which was somebody had hooked up artificial intelligence to an audio capability, and the reporter was having a conversation with this AI contraption, which was very, very impressive indeed. So there is certainly a lot of potential here in AI, and it's been viewed as a potential, gold rush. And everybody knows that in a gold rush, you want to invest in the companies that are selling the picks and all the other tools that are necessary to find the gold. And there aren't too many of them. There's clearly NVIDIA is a big one. And then there's a couple of others, and they've all absolutely soared in value. So again, that's all very, very exciting stuff. But there's always the potential here that the market's a little bit of ahead of reality, and that's some of the things I discuss in the morning briefing for tomorrow that I'm writing. What I want to do now is get into sort of an update of our earnings outlook and discuss some aspects of how can we tell if what is occurring now and might occur ahead of us is in fact a melt-up, or as Alan Greenspan famously asked in 1996, how do we assess whether we're looking at irrational exuberance? So let's look at some charts. Before I do that, some of you very kindly followed up with emails asking about Max. Max isn't here right now. He's fine. He's out and about. I think he's upstairs with my wife in her office. And Max wasn't feeling too chipper last time, but he's much better now. We changed his diet. He didn't really like the food he was on for a couple of weeks. It was supposed to be better for him, but Max is very fussy. So anyways, thanks for your good wishes. He's absolutely fine. No problem whatsoever. And so is Chloe, and so is Bailey. And visiting us today with my mother-in-law is her dog, Oscar. So we got a full house here. But let's move on to business-related matters. So let's go here to the charts. And I hope you're all enjoying the new chart format as much as we're enjoying using the technology to put them together. We're toying around with offering you a situation where we can provide you with, let's say, 10 charts, your favorite charts that you just want to have immediately accessible to you and that are immediately updated. And we can provide you with a, sort of a customized chart book with your own link, knowing that it's always going to be the latest data. So we're working on that. Hopefully within the next few weeks, we'll try it on some of you, see how you like it, and then we'll expand it beyond that. But this is the February 20th, today's collection for the morning briefing. And we're focusing on earnings. Earnings have recovered. We had a very minor earnings recession last year. It didn't last very long. And it was really a profit margin recession. It wasn't related to anything having to do with revenues, because revenues were not only holding up because there was no recession, but they were doing well because prices were going up. But some of those price increases were offset by the profit margin getting squeezed. And so the reality is we had this minor earnings recession. And because we didn't have an economic recession, revenues never went down. Instead, they continued to go to new record highs. And so we did have a bear market. That didn't really last all that long compared to previous bear markets. It was a fairly conventional bear market, down 25%. I think it was January 3rd of 2022. And it was over by October 27th of October 12th of 2022. So that's a fairly conventional bear market. And then we've been in a strong bull market ever since October 12th of 2022. We had a traditional correction last year between I think it was late August and I think it was August 31st through October 27th. And so we had a 10% correction then, and then it's been a rocket ship ever since then, kind of something that really looks quite like a melt-up reminiscent of the late 1990s, which is a subject that I've been doing more research on, more writing about, reminding you of some of the events that happened back in the 90s and looking for similarities and differences. For the here and now, this shows you the quarterly estimates of analysts for earnings per share. And you can see that once again, we've had this traditional hook. You can see it happens on a regular basis that analysts lower their numbers going into an earnings season. And then lo and behold, they turn out to be better than they anticipated. And we had sort of an earnings hook here in the second quarter. We had an earnings hook in the third quarter, and we've had another one here. So that's obviously meant that the estimate for this year has improved. Now, by the way, the fourth quarter is almost an irrelevant quarter. It's our view that the market discounts forward earnings, and forward earnings is a time-weighted average of analysts' expectations for the current year and the coming year. Well, the current year is here and now. It's 2024. It's not 2023. And yet we're now kind of looking at all these numbers for the fourth quarter of 2023. They only matter to the extent that they have an influence and impact on the expectations for 2024. So let's have a look at that. So again, better than expected, but again, better than expected is par for the course with these earnings hooks that occur on a regular basis. You don't usually get earnings hooks during recessions. During recessions, analysts aren't too good at anticipating them. And as a result, the earnings turn out to be worse than they expected. So you typically get earnings hooks when the economy's doing fine. The analysts turn, especially the ones that have a problem with their companies, they tend to get the feedback from the guidance of companies that there's a problem. They tend to reflect that. So the troublemakers tend to be reflected kind of going into the earnings season. And the ones that have really good news to report tend to like savor it, wait for the excitement of announcing it to the world how much better that they did. And we've seen companies enjoying the results of that recently, like Facebook and Nvidia, of course. So here's the estimates for 2024. And you can see that the Q1 estimates have been going down. So presumably, whatever analysts heard during the fourth quarter caused them to become a little bit more cautious about the first quarter. Second quarter, same thing. Third quarter, kind of flattish, and fourth quarter on the way up. When we look at the annual numbers, and by the way, there's a discrepancy sometimes between the quarterly numbers that we just looked at and the annual numbers. Are actually calculated somewhat differently, but they're in the same ballpark. And what you can see here is that the expectations for 2023 have actually been fairly level right around 2020. They got up to, I guess, if we look at 2023, they're up to 222, let's say. We've been talking about 225 for over a year. And more than a year ago, talking about 2025 seemed delusional because everybody, or a lot of people, were in the recession camp. Wall Street strategists were saying, yeah, we could get down to $100 and $180 a share. Maybe the optimists were saying $220 a share. We were saying 225. And so it's pretty close to a bullseye in terms of our number relative to what's happened. We still have the retailers. I guess Walmart reported better results. Even Home Depot reported better results. So when the retailers are coming in, maybe that'll add another dollar or two. But even if it's $222, that's pretty close to 225. So we count that as a pretty good hit. Now, looking at the year ahead here, 2024, the analysts collectively right now, and this changes every week, are talking about $243 a share. And then for 225, they're talking about 275. We're using 250 for this year and 270 for next year. But as we said before, as I've often said, we look at the annual numbers, we look at the quarterly numbers, but we think the market looks ahead 52 weeks. There is no such thing as 52-week earnings, right? I mean, you go to an analyst and say, what do you think earnings are going to do over the next 12 months, 52 weeks for your company? They'll look at you like you're from another planet. You obviously don't know how this business is run. The analysts will tell you, we do quarterly, we do annual, we don't do 52 weeks. So IBES a while ago came up with this very clever proxy for 52-week forward earnings, taking the time-weighted average of the current year, and the current year had been 2023. And at the beginning of 2023, they were identical. Forward earnings was identical to actual earnings for the expectations for 2023. And then you can see as the year progressed, as 2023 progressed, it became less and less important because we gave more and more weight to 2024. And so at the beginning of the year, the expectations for the year were the same as forward earnings. Forward earnings were the same as expectations for the year. And now we're going to be converging towards this number for 2025, which right now is $275 a share. So I think that's what the market's discounting. This will probably be lowered as these numbers typically tend to be too optimistic. But the question for the market is, how does the market do well if the analysts are lowering their estimates all the time? Well, they start out too optimistic, but again, when you connect the time-weighted average, you have an increasing trend during expansions, and that's what the market's discounting. It's always looking forward. These are just some growth rates here for the analyst consensus expectations. We now have numbers for 2026. Again, are we having fun or what? I mean, time really flies when all of a sudden we're looking at 2026. Before you know it, we'll be looking at 2030, 2040, 2050. Hope we all live that long. I wrote a book in 2018 looking over my career the past 40 years. Now I'm working on the next 40 years, so knock on wood. So here is the annual growth forecasts. So this was revenues. This is earnings. So this, you can look at it at your leisure when you have time. This is figure 6, looks at operating earnings per share. And these are our numbers. So our numbers are, again, 250, 270, 300. And every single week, we're updating the analyst consensus expectations. They change every week. We don't change every week. As a matter of fact, people have asked us, why haven't your numbers changed? And it's because they've been working out. So we're going to stick with these numbers. They haven't changed. And so, when you look at it on a chart, that looks like this is a logarithmic scale, ratio scale. And so I think it's kind of a pretty reasonable forecast. And again, you can look at the implied growth rates in our YRI earnings projection publication. It's on the website. This is revenues. Again, this is our numbers here, and this is what the analysts are looking at. So it's kind of early on, but I think these look like pretty reasonable numbers if we don't get a recession. If we get a recession, these numbers will be obviously too optimistic. But we haven't had a recession the past 2 years. We still have one, I guess, this year, but that's not our forecast. This is the margin expectations. And again, we're in the roaring 2020s camp. We're not saying that it's inevitable. We're not saying that it couldn't be. It could be the 1970s again. How could that happen? Well, pretty obvious, pretty clearly what could happen is the geopolitical situation in the Middle East could get a lot worse. Hard to imagine how it can get, well, it's not that hard to imagine how it could get worse. It could get a lot worse, and that could disrupt the supply of oil. The price of oil could spike up dramatically to 100, 125, 150. And all of a sudden, it's deja vu all over again, the 1970s all over again. Two energy spikes back then, two energy spikes now, and then we get a wage price spiral, and so on and so forth. But that looks obviously less likely. And now, instead of just focusing on the 1920s versus the 1970s, we're also focusing on the late 1990s. Should we be partying like it's 1999? So that's the margin. So the margin forecast is very optimistic. New record high. People are kind of used to the margin doing not much of anything. High single digits, low double digits. But we have in fact seen an upward trend in the margin, and we're expecting the margin to go to 13.2, 13.7, 14.6. And here's the analysts' expectations. And there's a little dot there for the red. We just started to get the 2026 number. Now, when we do our work on the markets, that was the margin. We're also looking at forward earnings that we project, and so the forward earnings projections are then applied to forward PEs. And this is the forward PE projection, 16 to 20. Now, again, that seemed pretty delusional back when we got down to 15. Let me see, did I get that right? This is it. This is the bottom of the bear market. We got down to 15, which, when you think of it, is remarkably high. That's considered to be fair value for the that 15 is considered to be a fair value for the PE. That's not the kind of PE you typically get in a recession. This is a more typical PE in a recession, 10. You go back in history and it's like 6, 7, 8. I know that a lot of people think that the PE is highly correlated, determined by interest rates and by the inflation rate. But I think it's also determined by the business cycle. When inflation is high and the Fed's raising interest rates to bring inflation down, PEs go down, partly because interest rates are higher, but also partly because it's expected that the tightening of monetary policy will cause a recession. So you get sort of a double whammy on the PE to the downside. Here, the market figured out that 15 was low enough, where the odds of a recession seemed to the market seemed to acknowledge that recession was becoming less likely rather than more likely. And then, of course, along the way here, there's an acknowledgement that the mega cap 8 stocks, as I like to call them, rather than I focus on them because I like Netflix movies. Magnificent Seven doesn't include Netflix, but we used to look at Netflix as one of the fangs or whatever. So at this point, talking about a range of 16 to 20 seemed totally delusional. But here we are at 20, and I think, again, that just reflects our view that the mega cap 8 are here to stay. They're going to have high multiples relative to the 492 components of the market. If we get ourselves into a recessionary environment, maybe we'll be going back down to 16, or we get that kind of scare. So here's our latest views of the market. Haven't changed. 5,400 is the top end of the range here, acknowledging that there are risks, as there always are. But we tend to lean towards the bullish case, especially when we don't see a recession. And so we're talking about 6,000 for next year. And then we just added this 6,500 for the year after that. That's not a very big increase, but again, I think it's realistic and in line with a fairly conventional upward trend in the S&P. Meanwhile, we continue to look at weekly forward data, which is the time-weighted average of analyst consensus expectations. This is forward revenues, and this is the actual revenues, the actual multiplied by 4 to annualize it. And then the forward earnings is an annualized number. It's automatically annualized because it's a time-weighted average of the forecast for the current year and the coming year. And you can see that that's at an all-time record high, and it's a coincident indicator. It's a kind of a leading indicator because it's available every single week. So that's looking pretty good. This is looking pretty good. This is operating earnings for the S&P 500. Again, it's the actual number in blue, annualized, multiplied by 4 simply. And then looking at the forward earnings, all-time record high, $247 a share. And this is the margin calculation. So you can see, again, it's a very useful indicator. It doesn't work in recessions. Analysts don't anticipate recessions. That's not their job. Like everybody else, they're surprised by it, except for every now and then you get an economist or two see it well ahead of everybody else. We had a just very strange situation where the glory went to economists who didn't call a recession. So it's an interesting kind of set of circumstances. Let's move on here. I'll pass on this. This is just looking at forward earnings as a leading indicator. And again, it doesn't do a very good job of anticipating recessions. These are leading indicators and coincident indicators. Doesn't do a very good job of anticipating recessions, but it did help us. But it does work really well when the economy is growing. So if you happen to agree with us that there's no recession up ahead here, then forward earnings are actually a pretty good coincident and leading indicators of where earnings are going, which is continuing to make new record highs. And this helped us quite a bit because, as you can see, it dipped here, raising the warnings about a recession. We were saying it was a profit margin problem, not a revenues problem. And when we started to see this turning around, we felt more confident with our no landing, also known as a soft landing scenario. So back to the Meltups. We've been spending more time trying to look for indicators. How do you know you're in a Meltup? Well, one way to do it is to look at analyst consensus expectations for long-term earnings. So we just looked at all these forward earnings numbers, which reflect analyst consensus expectations for earnings this year and next year. What we're doing now is looking at their expectations for earnings growth over the next three to 5 years. And that data is available. We had the good fortune, I had the good fortune of hiring Joe Abbott many years ago. He had worked at IBES, which has now basically become the LSEG group, the London Stock Exchange group. So just by happenstance, everything fell into place that our focus is on what I think and what Joe thinks are the correct earnings to focus on in terms of expectations, because IBES looks at the majority consensus view of industry analysts. And so we find the data to be very helpful in our thinking about PE times E. And so here you can see that the long-term earnings growth had it averaged, this is a moving average over time, so it averages 12.5%, which seems like way too high relative to what the economy can deliver. This is nominal GDP growth rate is 6.3%. So the average expected growth rate over the next 3 to 5 years is about twice as high as nominal GDP growth. That just reflects the underlying bullishness, optimism of analysts in their companies. I mean, it's not going to be too many analysts that are going to be covering companies that or industries that they think are going to go out of business unless they're working for a short only kind of hedge fund. Most analysts would like to cover companies that they're excited about. They see potential, they see growth, and so they do tend to be optimistic about and biased in that direction. But we can factor that in. The market clearly understands that. But when you see something like this, it does kind of alert you to a melt-up. When the analysts got so excited about the stock market going up, I mean, look, there's a lot of pressure on an analyst when their stock prices are going up. If they stay bearish and they miss the whole thing, it's pretty depressing. So they do tend to get whipped up into exuberance when the market exuberates. So it kind of feeds on itself. It's certainly a feedback loop. And you can see that reality came in. This was the bear market where the tech wreck occurred, continued to lower long-term earnings expectations. Then we got somewhat optimistic here since 2015 until the pandemic hit. And then that optimism on long-term earnings growth took a dive. And then, bam, we went straight back up. And then down again, and now we're in what could potentially be a melt-up situation, or an indicator indicating that we're in a melt-up situation. This is the PE of the S&P 500 versus this long-term earnings growth variable that we have available on a weekly basis. And so one can say that a multiple of 20 is justified is justified by earnings growth of 18%. Why not? And the answer is, well, this may be, they may be interacting in an irrational, exuberant way where, again, the analysts are raising their numbers because the market's going up, and the market's going up because the analysts are saying, hey, this kind of makes sense. Anyways, this is the PEG ratio, which we don't pay much attention to because don't find much value in it. But though we do like to look at the two components and how they're interacting. This is just going back to explaining why LTEG is so high these days. Mega Cap 8 now accounts for 28.2% of the S&P 500 in terms of market cap, 18% of earnings, and something like 10% of revenues. We did an LTAG. Joe did this for me. Joe's my wizard when it comes to this kind of information. So I asked him to put an LTAG together of the Mega Cap 8, and this is it here with their PEs. So long-term earnings growth, Mega Cap 8 forward PE. You can see that back here it was over 35, and here's what it's doing now. The long-term earnings growth rate has soared. Why did it soar? Well, here's the LTAGs. Again, Joe's a master at this. This is the LTAGs for the Mega Cap 8. And look where NVIDIA is at 102% per year over the next 3 to 5 years. So that's clearly been driving LTAG up and the market up. And Wednesday is going to be fun. Wednesday afternoon is when we're all going to be tuning in to hear what NVIDIA has to report. So with that, I am more than happy to welcome one or two more questions, because right now we don't have too many. Let me see. Okay, so this is from John. You were worried about a melt-up. Would you trim stocks now? No, I wouldn't. Look, melt-ups are great. You make a lot of money on the way up. Just you have to remember to get out. I'll be looking for some bells to ring to say that this thing is getting close to the end. You might have noticed, and we mentioned it in quick takes, that on Saturday, the Wall Street Journal had a story about teenagers investing and how they might be better at investing than some of their parents. So I thought that was a ding, 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 a bell ringing off that the kids are starting to be investors again. Well, at least they're not doing the meme stocks. Instead, they're all piling into Nvidia and Microsoft and stocks that made sense, but maybe they made more sense a year or two ago. Eric, how will the surging dollar impact earnings in Q2? I haven't noticed that it's actually surging, maybe relative to expectations that it will be weak. I mean, the dollar weakness stories have been out there for a long time, and we know that the axis of evil, as they're called, have been plotting to create a different currency so they wouldn't be so dependent on the dollar. The dollar's been firm, and I don't see that having a deleterious impact on earnings. Maybe what will have more impact is the fact that the global economy remains quite weak. Japan is in a recession. The UK is in a recession. Germany looks like it's deindustrializing the way things are going. They're competing with with very good EV cars made in China, with Tesla and so on. And then, of course, China's got its problems. They've cut their interest rates. They've tried to stimulate their stock market. But history shows, history most of us lived through, that property bubbles like the one they had in Japan and like the one that we had could take 5 to 7 years before they stop to be a weight on the economy. I'll take one or two more because I've overstayed my welcome here. Chip, your margin expansion estimation to 14.6 is likely to be the most compelling of stock market stories. Kindly provide your sentiments. Yeah, well, it's just consistent with the roaring 2020 story that I've been telling. It's consistent with the productivity-led economic growth that I've been telling. Productivity is fairy dust. It's marvelous for boosting real GDP, for allowing wages to rise faster than prices. So even if you don't have rapid increases in the number of consumers, their purchasing power increases, and it's great for profit margin and profitability. But stay tuned. I'll be writing a lot more about it in the morning briefings. I'll take this as a final one. You mentioned that the market was able to figure out a bottom at a forward PE of 15.5 versus previous bear market subs of 10 or lower, by the way. Over your time as a strategist, do you feel markets have overall become more efficient at pricing in forward outcomes or less efficient? It's a good question. I don't have a sense one way or the other that the markets are any more efficient than that. I think they're just as prone to irrational exuberance as ever. So that's why I'm paying more attention to that possibility. On the other hand, the fundamentals are different now than they were in the late 1990s. And so right now, it may very well be described as rational exuberance rather than irrational exuberance. If we're focusing on the valuation multiple, I can't argue with a 20%, a 20 PE, and at the same time tell you that I think we're in the roaring 2020s. If we're in the roaring 2020s, then we should have a higher PE, and we have that, and it certainly can be explained by the fact that in the roaring 2020s, we've got 8 companies that are roaring ahead here. They are much more solid companies than we had in technology back in the late 1990s. So right now, it all makes a great deal of sense. What doesn't make a sense to me is the narrowness of the market. I've had this view that all stocks are tech stocks. All companies are tech companies because you either make technology or you use it to increase your productivity. So I continue to expect that there'll be a widening, a broadening out of the market. And as I've documented recently, when you look at the bull market since October 12th of 2022, it really isn't just, that the mega cap 8 have totally dominated the market. They have in terms of their performance. I mean, just major double-digit increases, but they've really stood out, of course. But it's not as though there haven't been good old plain 20% increases in lots of other parts of the market. So that's the way I've been looking at it. Anyways, let's all have fun here on Wednesday afternoon, see how the NVIDIA story goes and how that impacts the market. I'll be writing a little bit about it for tomorrow's morning briefing, which you'll see in advance of later today. Thanks for tuning in.